Bank B, however, is in a better market and may gravitate more towards lower risk products because they may have a larger market share within their current market. The second step in the development process in the risk management framework is ranking your portfolio of risks. Some risks may be more difficult to manage than others, and the process of assessing the level of importance of each individual organization is necessary. Questions to ask bank managers when analyzing and ranking a portfolio of risks include: which ones can be easily refinanced or liquidated? And which ones are most detrimental to the business strategy of the bank? These can be very important because when looking at the current crisis and what had just happened, many banks in ranking a portfolio of risk may not have asked themselves where they could access liquid funds to be able to pay off their debt. The same risk within one organization may be more risky in a different organization depending on their current portfolio of risks. Higher and lower exposure in different organizations can also occur. In the recent crisis, it has highlighted the vastly different risk profile attached to the refinancing of banks' mortgage portfolio versus a non-bank. The third step in the development process is quantifying your risk appetite. Determining your risk appetite within a bank can be very difficult depending on the different risks that you have invested in. One question to ask yourself might be, what is the current operating environment within the market? Different situations. These situations can be done through different tests. Stress tests has become the forefront of many of these questions. Stress testing has been widely used during these economic times. What is the current cash flow within the bank? Do we have funds that can be easily liquidated to generate cash? And what steps or what processes within the bank need to be reevaluated to determine a better cash flow? And the third is, what is the overall bank strategy? What are we trying to accomplish within our bank? Are we looking to hold more deposits? Are we looking to integrate more residential mortgages, different commercial mortgages? And another is the balance sheet capacity. How big is our bank? What can we do to better improve our balance sheet? The fourth step in our process is merging your risk blueprint with the organizational strategy. By this point, the bank should have its overall strategy in what they're trying to accomplish. Problems that have arisen is because usually within a bank, or many other companies for that matter, it's usually highly fragmented. As we'll see in the next slide, different processes are handled by in different places, and confusion can arise very quickly. A company should and may look into establishing a better governance and management structures within their company, and building a better infrastructure. An up and down approach has been widely used to better organize an organizational strategy. A better infrastructure may help improve the overall function of the bank. This slide shows a typical business unit risk function structure in a large and diverse bank. In many banks, the CFO function is often responsible for enterprise and risk activities, and committee oversight may be conducted through a smaller number of committees, as shown by committees A, B, and C within the business unit. These may also have to be tied together to be reassociated with the specialized risk areas. There's an increased trend in smaller organizations, however, for more transparency in the risk activities overseen by the CFO and the board of directors with separate independent risk oversight, often established to provide the board with the desired level of confidence. Today, this structure is trying to be reorganized so that it is more of a top-down approach, as you can see in the highlighted area to the right. This slide can be further analyzed later in this presentation for more references. In this section, we'll address the economic capital risks within a bank holding company. The first type of risk is credit risk. Credit risk is defined as the chance that a borrower may default on a loan. While there have been many reasons why financial institutions have faced difficulties historically, the major causes of serious banking problems are directly related to credit standards for lenders and borrowers. A credit risk framework focuses primarily on the measurement of credit risk, credit controls and risk administration, including monitoring compliance with credit risk limits, and establishment of regulatory and economic capital required to support credit risks. Ways to lower this risk include a better credit assessment of lenders and borrowers, credit analysis, better underwriting, and a portfolio analysis and management system integrated for each specific bank holding company. The second type of economic capital risk addressed in this section is market risk. Market risk is defined as the sensitivity of the value of assets to changes in market prices or risks. Market risk has come to the forefront in the generation of management information and oversight, establishment of trading limits and control of trading operations, and performance evaluation, asset and resource allocation, including hedging decisions and regulatory reporting and risk oversight. Different market risks occur in trading risk, interest rate and currency risk in the balance sheets, and equity and credit market factors. The third type of economic capital risk is funding and liquidity risk. The concept of liquidity is increasingly important in managing financial risk. It is driven by the structure and depth of markets, volatility of market prices and rates, the presence of traders willing and able to make markets and commit capital to support trading, and the trading and leverage of strategies deployed. The two biggest types of risk in this is the funding and trading liquidity risks. Ways to lower these occurrences include structural funding and liquidity management systems, scenario stress testing, and crisis and contingency planning. Funding liquidity risk refers, of course, to the ability to meet funding obligations by either financing through sale of assets or by borrowing. A great example is during the recent crisis-driven drying up of access to debt securities markets globally, which forced governments in most jurisdictions to provide massive window facilities to market participants that we have talked about during this class. Trading liquidity risk, a good example of this impact of the risk was demonstrated during our crisis when interest rate derivative spreads increased markedly with the drying up of product availability in combination with the ongoing need for hedging transactions within the current market. The final section is operational risk. The management of operational risk requires systems capable of identifying, recording, and quantifying operational failures that may cause financial loss. The systems are essentially tracking processes that monitor the behavior and performance of existing systems and processes. The essential elements include the ability to track and monitor performances of specified operational processes and systems, maintenance and database of operational loss experience history, and the capacity to provide exception reporting or initiate actions to enable intervention to reduce operational risks. Some operational risks include internal fraud, which could be the misappropriation of assets, tax evasion, intentional mismarking of positions, or bribery. External fraud, which is the theft of information, hacking damage, or third-party theft or forgery. Employment practices and workplace safety, which is the discrimination, workers' compensation, employee health, and safety. Another example is clients, products, and business practices, which could be market manipulation, antitrust practices, improper trading, product defects, fiduciary breaches, or account churning. Damage to physical assets,